Hi, I'm Andrew McNair, and this conversation happens every weekend at family reunions and backyard barbecues. The dominant financial discussion is how much someone makes or will earn in their next new job. We measure how well our brother in law is doing based on the income that he's pulling down. Our culture puts income on a pedestal, but this misses the point entirely. What I found to be the biggest determinant of financial success is not how much money you make, not how much your net worth is, and not the rate of return you're getting on your investments, but it's this. What percentage of your income are you actually saving? It doesn't matter how much you make, it matters how much you save. When planning ahead and saving money, it allows you to be a good steward of what God has already given to you. In Proverbs chapter 6, verses 6 through 8, it has a great example for us. Go to the ant, you sluggard, consider its ways and be wise. It has no commander, no overseer or ruler, yet it stores its provisions in summer and its food at harvest. Saving for the future allows you to be prepared for what lies ahead, prepared for retirement, prepared for the future. We don't need an overseer or ruler. We know that we need to save, but let's talk about how you could do it more effectively. So when people talk about how much they're making, that misses the point completely. It doesn't matter how much you make if you're not saving any of it. And I mean really saving, like sticking it into an account that you won't see until your retirement age. So how can you save more? That's the focus of today's video. Let's start with a question I get asked all the time. How much should I have saved by now? That's a great question to make sure that you're on track, one that's individual to each and every person. It's not an easy question because it depends on a lot of variables like your age, income needs, and the needs that you'll have at retirement, and the age that you want to retire. But ideally, you want 3 to 6 months of expenses as an emergency fund where you can access it easily. Then retirement is a whole other ballgame. Let's assume in retirement, you're going to maintain the same standard of living that you have now, because who wants less? You're going to want the same standard of living or close to it because you don't want to have a big drop in income at retirement. So how much should you have saved? Here's the best rule of thumb I've ever heard and encountered. It's what I call the millionaire formula. It comes from the book, The Millionaire Mind by Thomas Stanley. And it's a simple formula that anyone can use, and I love it because it skews harder on young people who need to get back on track, and it's a little bit easier for people older. Here's how it works. First, take your household income, then multiply it by how old you are, then divide it by 10. This is the amount you should have saved by now. For example, if you're 40 years old and you earn $150,000 per year, then 40 times 150,000, divide that by 10, therefore, you should have saved $600,000. And I recommend this formula because many families I've encountered say, Andrew, I've done it. I've crossed the finish line. I'm a millionaire. I've saved $1 million. And that's fantastic. It's a big accomplishment. However, if they're earning $300,000 or more and have been investing for 30 years, that $1 million isn't going to be enough to maintain their lifestyle in retirement. They're going to blow through it so quickly. So what you need to save for retirement should be relative to you and your lifestyle. If not, when you retire, it won't be long before you're unable to maintain that standard of living, and therefore you're going to have to make serious cuts or go back to work, which no one wants to do that. No one wants to put their travel on pause, wait 30 years of retirement, and then have to only do it once more. Now that you know how much you need, let's get practical. The best formula for saving more actually starts off with giving. The Bible says that your tithe belongs to God. So the first transfer you're making or the check that you're writing once you get paid is 10% to your local church. I've seen it time and time again. If you cheat God, you'll always cheat yourself. Then saving is the next priority after that. When it comes to saving, I encourage my clients to save at least 20% of their gross income, not their net income, their gross income to long-term investments. This should be your goal in order to reach and maintain that millionaire formula that we just talked about. Now, this isn't delayed spending where the money goes into a savings account for you to spend it later. That's delayed spending. No, this is putting your money where it can multiply, where compound interest can work its magic. 20% is critical to making sure that you have enough saved for retirement, and you may need to consider increasing that amount if you're behind in order to play catch up. That's where a financial advisor can really help. I know saving 1/5 of your income can't happen overnight. For most people, it takes a lot of work. A good starting point, though, is saving 10% and steadily increasing it from there. If you can't save 10%, that means that you're going to need to make some tough calls like downsizing. This may mean moving to a smaller house or having only one car for your family. You need to take a hard look at your budget to decide what is a priority and what is truly discretionary. Then after you've gone into the habit of saving 10% of your income, now you can move on to saving 15% and ultimately 20%. And don't stop there. You can always continue to increase it past 20% like me and my family have. By saving 20%, not including a 401k match, you'll be on the road to financial success because you'll be saving enough to help jumpstart that compound interest machine. Don't include the 401k match. In my opinion, that's cheating. That's what your employer's doing. Now let's look at a few pointers to increase your savings. One of the best ways to look at your finances is through a good old sports analogy. Most sports break down between offense and defense. Whether it's soccer, football, or hockey, they all break down to making sure that you play really good offense and that you make sure that you protect your team with a great defense. The same goes with your finances. You can't be overly focused on one and forget the other. First, you can save more by playing better offense. This means increasing your outputs. You should be working unto the Lord. You should be the best employee that you know at your workplace. You should be the best business owner in your marketplace. And how can you up your offense? Finally, get up the courage to ask for the raise or promotion with your current job and get a new job that pays more, or take on a second job to create another income stream, or actually raise your prices for your business because you're offering a better product. Take your weekends to bring in extra cash instead of just doing that hobby. All of these are great tactics to raise your income and play better offense. What do most people do with the increase of their income? That's right. They increase their spending. Their standard of living goes up that much faster. But when you get a new promotion, a new job, a pay raise, don't automatically upgrade your lifestyle. Don't raise your expectations. What I recommend is that you save half of your new increase in income for your future self. Why? Because you're not used to making this new amount. You're already happy spending what you're spending right now. Now with the other half, enjoy it, spend it, buy an extra TV, a better car, improve your lifestyle. If you practice this approach methodically and increase your savings rate with every increase of income over time, you'll catch up to or exceed that goal of saving 20%, and you won't even realize it. It is a pretty handy tool, and you can do the same thing with your tithing as well. But we also want to talk about defense. Don't neglect defense, because that's how games are often lost, of course. So let's talk about how you can save more by working with what you already have. How can you do that? First, write down your spending. I call this a spending plan. No one likes a budget. A spending plan is where you write down where you've been spending your money over the last 3 months on a regular basis. Then divide every transaction into 2 major categories so that you and your spouse can go through this. And here's what I would recommend. Write a category called mandatory and the second column called discretionary. Another way of thinking of it is needs versus wants. If you're married, this is a great exercise to go through with your spouse and say, is this truly a mandatory expense, or is it honestly a discretionary expense that we can reduce and take a red pen to? Many times, all you have to do is cut out what you can and squeeze your belt just a little bit tighter, because it could be the difference between saving for retirement or working well into your 70s before you can retire. Now, keep in mind that the estimated lifetime value, for instance, of a Starbucks customer is over $14,000. That was added up before the inflation that we're seeing now. Can you imagine? That's just one thing that we can point to. It is a $5,000 value over your lifetime. You might think you're buying a $6 or $7 latte now, no big deal, but frequenting a coffee shop can equal hundreds, even thousands of dollars per year, and we're not even taking into consideration the compound interest of it if you were to invest it. If you're not a coffee drinker, replace it with your Achilles heel. Decide if it's truly worth you not retiring on time. Make the hard calls that are going to pay off down the line. So don't forget offense and defense when it comes to your finances. You can strengthen your offense by increasing your income potential over time, but a poor defense will leave you vulnerable to overspending. Put in a very direct way, rich people invest first and spend what's left over. Unfortunately, poor people spend first and invest what's little left over. One final way to save more is to stop looking at your tax return as a gold mine. Tax returns are wasted, rarely invested, and never given away. Instead, see your tax return as a forced savings account that the IRS has set up for you. Many times, families will receive $5,000 as a tax return, but what do they do with it? That's right, they spend it. There are entire industries and marketing campaigns out there that focus once a year on making sure they separate you from your tax return. Take this large lump sum and instead add it to your Roth IRA or invest it in your future or give it to your local church or charity. Your life was fine before the tax refund, and your life will work itself out after the tax refund season's over. You'll never miss it. Put it in an investment account and you'll be shocked at how much it will grow over time. Believe me, when it's time for you to retire, you'll be glad you did. Well, that's all we have for today. Don't forget to check out my new book, The Giving Crisis, by going to richyoungandpowerful.com/book to pick up a copy today. Also, be sure to check out my podcast, Rich, Young, and Powerful, to hear from philanthropists who have dedicated their life, talents, treasures, and platform to worthy ministries that you can be a part of today. Check it out on iTunes and Spotify, and be sure to subscribe so you don't miss any of these other videos. Until next time, remember to invest your life into something that will outlive it. Now that's living to give.